At 9 a.m., your phone buzzes, a notification from your bank. Your balance looks fine. The cafe is full. Traffic is loud. Everything feels normal. But somewhere far from your screen, a small group of people just pressed a button that quietly made every loan in the country harder to afford. Not tomorrow, not next year, today. And most of the economy won't even realize what happened until it's already slowing down. This matters right now because over the last few years, the world went from money is cheap to money has a price again. Mortgages doubled. Credit card interest quietly crept above 20% in many countries. Governments are paying more just to stand still. It feels like chaos. It isn't. It's design. The button has a boring name: policy rate, target rate, benchmark rate. People argue about what to call it, but the effect is the same. Move this number up a little, and the entire economy starts to walk instead of run. Here's the strange part. The people who press it don't control how much you earn. They don't decide your rent. They don't pick the price of eggs. Yet one decision can change all three. Imagine the economy as a giant system of pipes filled with money. Households, businesses, banks, governments, everything flows through credit, loans, payments, promises. The button doesn't change how much water is in the system, it changes the pressure. Low pressure means money moves easily. High pressure means it struggles. When the button goes down, banks borrow cheaply, so they lend cheaply. So people buy homes, companies build factories, startups burn cash, governments roll over debt without sweating. When the button goes up, that whole chain reverses. Banks pay more to borrow. They charge more to lend. Loans dry up. Big purchases get postponed. Projects get canceled. No sirens, no shutdown notice, just a million people deciding to wait. Now here's the uncomfortable math nobody likes to say out loud. Most modern economies don't grow because people save. They grow because people borrow. Mortgages, car loans, business credit lines, government bonds, that is the fuel. So when the button moves, it doesn't hit spending evenly. It targets the most debt-dependent parts first: housing, construction, startups, governments with big deficits. You don't feel it instantly. That's the trick. At first, the economy looks strong. Jobs are still there. Stores are still busy. Headlines still sound confident. But under the surface, the pipe pressure is changing. A company that planned to borrow $10 million for a new factory now has to pay double the interest. The spreadsheet stops working. The factory never gets built. A family that could afford a home at 3% interest can't touch it at 7%. They keep renting. The builder doesn't sell. The supplier loses orders. Multiply that by millions. That is the slowdown. Now for the irony. The iron is usually pressed to stop things from getting too hot. Inflation, asset bubbles, everyone partying with borrowed money. So the public story is simple. We're cooling things down to protect you. But reality is messier because the pain isn't spread equally. People with savings earn more. People with debt bleed faster. Renters feel it before homeowners. Small businesses feel it before corporations. It's like applying the brakes in a bus where only the people standing get thrown forward. And here's the quiet power part. This decision is not made by elected politicians. It's made by committees most people can't name, meeting behind closed doors, using models that admit they're often wrong. They watch inflation charts, employment numbers, bond markets. Then they guess. If they move too slow, prices run wild. If they move too fast, businesses collapse. There is no undo button, only regret months later in the data. The public hears rates up 0.25% and shrugs, but on a government with trillions in debt, that tiny move can mean billions more in interest every year. Money that doesn't go to roads or schools, it goes to servicing yesterday. So the hype says this button keeps the economy healthy. The reality, it mostly decides who gets hurt first when things go wrong. Zoom out far enough and it gets unsettling. Every boom of the last 20 years was built on cheaper and cheaper money. Every crisis was solved by pushing the button down again. Now debt is enormous. Rates are no longer near zero. The room to maneuver is smaller. Which means the next time the economy truly stumbles, the people pressing the button may find it doesn't work the way it used to.